Think about this for a second, folks. 2020 is the first year since 1979 to have both gold and the S&P 500 mark new highs during the calendar year. So what is this signaling? Joining me today, Chris Mancini, senior analyst over at Gabelli Funds. Chris, so good to see you.
Thanks, Daniela. Same. Good to see you too.
So what is this telling us? First year since 1979.
Yeah, I think what it's telling you is that asset prices are going up because the Fed is buying assets with printed money, and rates are really low. So if you have, from a stock market perspective, if you have, that's an asset that's generating income. So if you, for example, Procter and Gamble, if you own Procter and Gamble stock and they make toothpaste and diapers and what have you, they generate income and they pay a dividend. And so with rates at zero, because the Fed's been buying assets and pushing pushing interest rates down, the market is willing to pay for that yield. And that's the reason that the stock market's up. And then the reason that gold is up is because the market's not sure how this is all going to play out. The buying of assets with printed money is a dangerous thing from an inflation perspective. And so as we see again the inflation in the stock market, the question is what's going to happen to the prices of other goods. And so people are buying gold now as a hedge against broader consumer inflation.
So you mentioned a really good point there, Chris. U.S. equities, some people I speak with say, look, everyone's saying it's overvalued, too expensive, but that's not the case. How do you see it?
Yeah, I see equities as being relatively cheap here, actually, because it is all about interest rates and the potential return that you get on buying those stocks. So right now, with interest rates at zero and real interest rates being negative, if you buy Procter and Gamble stock again, you're getting around a 2.5% yield. So that 2.5% yield for a steady stream of income is actually pretty cheap relative to the zero that you're going to get from owning, or actually negative that you're going to get from owning bonds.
Okay, so are you saying even if you're in, let's say, Apple, Netflix, any of these big players, you could still make money in U.S. equities, or should we be looking for the smaller companies?
I think that those big ones are going to do well because they're the ones who are really they're in the pole position, so to speak. They're the ones that are in a world where you have just a weak economic growth, weak economic overlay. They have access to capital, and they'll be able to do better than the smaller companies, which might not have as much access to capital, or the capital might be more expensive. So I think that, yeah, large cap companies which are growing and which are also generating income, paying a dividend, are the place to be if you're going to play the equity market.
Okay, how about mining stocks? I know this is your specialty, so talk to us about mining stocks and what we should be looking for, Chris.
So for gold mining companies, again, so specifically, that's what I do every day is the gold miners. I think that we want to look for companies that are really, again, have the best assets in the world. That's what we look for, companies with the best assets, the best managements, and are trading at reasonable valuations. If you put all that together from a producer perspective, what you should find is a company that is generating income and paying a dividend. So what we're looking for are, again, companies that own great assets with great managements that are generating free cash flow and paying dividends to shareholders.
Now, this is a trend we've seen. I want to say it's been like 2 years. We're seeing more and more miners pay dividends, which was not something they traditionally did before, correct?
Yes, correct. So before, in the last bull market, the miners were paid for growth. They were rewarded if they were building new mines. Now, the market and shareholders like us are saying we want to see some capital returned at these very high gold prices. So yeah, the trend now is to see these companies pay bigger dividends.
Chris, do you think, because you deal with these miners on a day-to-day basis, do you think they've learned their lessons from the last bull run? Are they in a better position today?
Yeah, they are for sure. They really are in a sweet spot. So after 2013, when the gold price got really slammed from around 1,800 down to 1,300 and then down to 1,050, the companies really did pare back expenses. They right-sized their operations. They optimized operations. So so they're in a really good spot as the gold price started going up. And so in this current bull market, they're generating lots of free cash flow, and they're not doing the same things that they did last time that got them into trouble in terms of building mines all over the place. So they're returning capital, which is
Would
good.
you be, so do you like the juniors? Do you like mid tiers? Do you like the majors when we're talking gold miners right now?
I mean, it's about what level of risk you're willing to take. So if we own all of them, and I do, and it's hard to say that I like all of them, but it's safer to have a bigger position in a diversified company like Newmont that generates free cash flow from mines all over the world, mostly in Australia and North America, than to have a junior that, say, is producing from 2 mines in West Africa. But we own both. And the question is just position sizing and risk management. So I think that there's value really across the board now.
How about gold versus silver? Where's the better play?
I think that gold is really the way to go in a longer term, in an environment where you're having currency debasement through all of this money printing, and the question again is to how this is all going to turn out. If this doesn't work out well, gold is going to be the beneficiary, not silver.
Are you seeing serious money flow into the gold mining sector right now, Chris?
We're actually seeing this year, we've very fortunately seen inflows into our fund. And in the past couple years, I mean, really during the bear market, we never really saw that. We would see kind of, on a good day, we'd see flows in, on a bad day, we would see flows out. And now what we're seeing is, especially when gold was really in its ascendancy, like in the middle of the year, we were seeing kind of consistent flows in every day, and we're still seeing like a little bit in, thankfully, knock on wood. So it seems like a good trend here.
Chris, I need to talk about Bitcoin with you, because you have probably been one of the most vocal people kind of, I don't want to say against Bitcoin, but yeah, against Bitcoin. And you made headlines when you came on with me in a past interview saying Bitcoin is corrupt because it's created by man, not by God, and gold at the end of the day will always beat Bitcoin. Has your stance changed since? Because that's over a year now. What are your thoughts on the crypto space right now?
Yeah, I mean, I don't spend a lot of time like looking at the crypto space, but the interesting thing is that those kind of forks, I think, have died down. I really haven't seen a lot of news of those happening, those kind of Bitcoin forks. But that was the issue of Bitcoin, was the concept again of someone creating something out of nothing and then becoming a millionaire just by saying, hey, look at this, look at what I have here all of a sudden. Whereas with gold, you obviously couldn't do that. I mean, we see every day what kind of blood, sweat, and tears it takes to get gold out of the ground. And to just say, well, I have a fork now of this thing, and all of a sudden I'm a multimillionaire, is again, it doesn't make sense. So, and at the end of the day, if and when this does play out in terms of a severe monetary debasement, governments are not going to tie their currencies to Bitcoin. They're going to tie it to gold, and so gold will be the beneficiary.
Blood, sweat, and tears indeed to get out of the ground. Chris, last point. Do you have a forecast for gold? What do you make of the price we're sitting at right now? Are we going to break through again?
This is actually a tough price right now. And it does seem like we had that big run up to, close to 2,100, and then we consolidated, took a little leg down. Now we're consolidating again. So this is like a really integral thing. It seems like the market's waiting for the election. I think if there's a Democratic sweep, I think that gold goes up a lot. I think that if there's a status quo, like I think that if we have say Trump in the White House and the House is split again, then I think that gold probably trends up again. I mean, it's about stimulus, it's about money printing, and I think that we're on a continual path there.
Let's play out that scenario. Why do you think gold goes much higher if there's a Democratic sweep? What's the thought process for you there?
I think that if there's a Democratic sweep, I think that it's much more likely that we'll see a huge fiscal stimulus. So I think that, the Democrats are now talking about, I think Pelosi was offering 2.3 trillion or something like that, or that was her, down from something like 3 trillion. So I think that if there is a Democratic sweep, that it'll be full game on, and they'll go with that $3 trillion stimulus. And I think the Fed will continue to buy bonds, print money to help finance that. And that's the path that we'll be on to that eventual inflation.
When you hear talk of $10,000, $15,000 gold, is that crazy or makes sense to you?
I mean, that's the end game. That would happen if there is like a severe inflation, and then the U.S. has to tie its currency to gold because there is an inflation. So that the market price is in a probability of that eventuality. I think we're far away from that, but I think that there's a good chance it will eventually get there.
All right, Chris Mancini, thank you for always keeping it so real. Thanks for joining us.
Okay, thanks, Daniela.
All right, and thanks for watching. We'll have much more for you, so be sure to stay tuned to Stansberry Research. In the meantime, follow us on all our social media platforms, Twitter, LinkedIn, Instagram, Facebook. We are all there. Thanks for watching. I'm Daniela Cambone.